Hi guys, my name's Wayne Quinton. I just want to share with you how professionals take their profit from property tax efficiently and how you can do the same too. Now I don't have time to cover Clause 24 and all the bits and pieces, but what I want to do for now is share two foundational principles, just two principles, and teach you why they will make you tax efficient as someone with 100 properties, 50 or 10. Even if you've only got one or two, I'm going to ask you to write down two statements I'm going to make, and these are foundational pieces, principles, and I'll explain why I've made those statements. Right, we want to be tax efficient from income tax, capital gains tax, and inheritance tax. So here's the two statements. First statement I want you to write down is never ever sell my investment property. So never ever sell my investment property. The second statement I'd like to write down is, by the way, some of you may feel a little uncomfortable with that. Just to warn you, but I'll explain. So the second one is, as the property goes up in value, increase my debt against it. As the property goes up in value, increase my debt against it. Some of you might be nervous with that. Now I will explain. So let's have a look at these in a bit more detail. Let's look at income tax. And remember, keep your energy high. We're talking about tax. At the end of this, you can decide if tax is exciting when you get it. So let's look at income tax. So here's a £90,000 property, £67,500 mortgage, and it makes £219 a month. Okay, in real simple terms, this isn't how it is, but if you're a 40% taxpayer, you pay 40% tax. If you're a 20% taxpayer, you pay 20% tax, and if you don't pay tax, well, you won't pay tax. It isn't like that, especially with Clause 24. Just for simplicity and to show you the principle though, just let's take this as it is. Okay? Now, let's assume how many people, if I ask you, when you was being brought up by your parents, did your parents bring you up and teach you that debt was bad and you should pay it off and not have any of it, and that saving was a good thing? Well, if you're anything like me, that was how I was brought up. And here's the thing. First of all, you need to thank your parents, because you wouldn't be in a position to potentially invest or have any interest if you hadn't brought you up like that. So, in an average room of society, about 60% of hands go up. So your parents have done you a great thing. However, here's the challenge. Your parents probably, if you put your hand up, are what I'm going to call savers, not investors. Now, a saver believes debt is bad, and an investor understands there's good debt and there's bad debt. So let me give you a definition to hammer this home. A bad debt, it's a debt that you have to pay whether you use something or not. So right now, today, you spent the day with me, but if you've got a mortgage and you're paying rent, that's a bad debt, because you've had to pay for the house whether you're in it or not. If you've got a car loan, you might not have driven the car for a week because you're away on holiday. You still have to pay for the car. It's something that costs you money whether you're there or not. That's a bad debt. A good debt, well, a good debt for me is two salient points. The first is somebody else pays for it, not me. And if you've got debt but somebody else pays for it, not me, this is piece number one. Piece number two, it also has to make me money on top. Somebody else is paying for it and it makes me money on top. How many of those would you like? An infinite amount, please. Therefore, how much good debt would you like? An infinite amount, please. Whatever you give me, I'm going to explain this in more detail in a minute. Right, Richard Branson. Whatever you think of him, you know he's definitely a successful businessman. He's been quoted recently with one of his written goals. That is, I want to be the first person to die with a personal debt of £1 billion or more. Personal written goal, because he knows if he's got £1 billion of good debt, what will he be making? Just a crazy amount of money. Now, I'm not saying get to £1 billion, you don't need to. Let's assume now we get the principle, and let's assume I take two identical people. I've taught them this stuff. One says, I get what you're teaching me, but I just can't help it. I was brought up by my family to pay debts down. I just have to pay the debt off, even though you're telling me not to. I've got to pay it off, so let's have a look and see what happens. So for the next 10-15 years, John, let's say, works really hard. Let's assume they've got identical jobs, they've got identical semi-detached properties, but they live next door to each other, identical incomes, and for the next 15 years everything is identical. The only difference is John takes his 67,500 of his hard-earned income and he uses it over the next 15 years to pay the mortgage to zero. Whereas, let's say Colin, his next door neighbour, was on my mentorship programme and says, I know better than that, I'm not going to pay it down. Okay, so what's the reward that John gets for his 15 years of paying it down? Let's have a look. If we fast forward this to 15 years, so John's paid the mortgage down to zero, so there's now £253 a month dropping into the bottom line. Extra income, so the government come along and they say, hey, you have the same jobs, you have the same properties, you've got the same amount of money coming in, but John, because you paid your debt down, here's your reward. I'll tax you an extra £100 a month. Congratulations. He has to pay. Brilliant. Everything identical. He has to pay an extra £1,200 a year because he paid the mortgage down. Would you ever pay the mortgage down to pay more tax? Okay, right. So, first rule, it doesn't link back to the principle yet, but we're not going to pay them down. We're going to take interest-only mortgages. If you've got a repayment mortgage, you're paying it down. By the way, while John was busy doing that, paying his mortgage down, Colin would have taken his £67,500, the same money, and had a lot of parties and invited us to him. Or he would have bought more wisely, more investment properties. So now he's got 4 going up in value instead of 1 like John. Another reason not to pay it down is it slows down your future growth. Okay, does this make sense? So, Colin doesn't pay the mortgage down. He keeps the property with the mortgage the same, but the trouble he's got, it's not really trouble, the rent is going up every year. By the way, you should always put your rent up every single year. 3 to 5% a year, every year without fail. I've done it for the last 20 years. Somebody doesn't move out for the sake of £30 a month. If they do, it's a coincidence. They were moving out anyway. So you've got to put your rents up every year. None of this, oh, I like them because they don't give me any hassle, so I'll keep it cheap. My response to that is always, so you love them more than your own kids because you're going to give it them cheap. Instead of giving it to your kids. Always 3 to 5% per annum. So, for Colin, his 650s become 670, become 690, become 710. 3 years in and he's got £710 worth of rent. His problem is, he's going to have to put an extra £60 a month on the bottom line. You have to pay more tax now over the next 3 years, There's been some inflation, so the maintenance might have gone up from 80 to £90. The other thing that would have gone up with inflation is the value of the house. So Colin goes back to the bank and says, hey bank, the house is worth a bit more money now. Can I please borrow 75% of the new value of the house? Of course you can. He's been putting the rents up, so that'll help pay for the increase in mortgage costs. You can borrow a bit more, but you'll have to pay more on the mortgage. The agent goes, that's fine. The increase in rent will pay for it. So, for easy numbers for me, let's assume the mortgage goes up to £300 a month. So Colin has to pay an extra £60 a month coming in, but he's got an extra £50–60 a month going out. His net income remained the same. His income tax remained the same, even though he's put the rents up. Does that make sense? Yes or no? So, if you follow the second principle, as the property goes up in value, increase your debt against it, you'll stay income tax efficient. Okay, but a bit more of that in a moment. Now, let's look. And I know, by the way, some of you are going to say 24 doesn't work, clause 24 doesn't work exactly like that. And some of you in your heads will be going, it's getting into the complex stuff, the detailed ones. You're going to be saying, well, once you borrow past the value, just let's get the principle first. That's what I'm trying to do. I'm just trying to give you the principle. And the principle holds true for clause 24. It holds true with everything else. And you'll see that as it makes sense. Okay. Look at the next piece, capital gains. So I'll buy a house for £100,000 on average. They double every 8 years in the UK, but let's say it takes 15 years to double. So 15 years, and now it's worth £200,000. Okay, another 15 years, and it's worth £400,000. Let's assume we then sell the house. Okay, so we sell the house. I'll go back to these guys and reverse roles. So Colin doesn't sell the house, and let's say John does. So John sells the house, and the government come along and say, well, you've got to pay capital gains. You're a 40% taxpayer, so it's 28%, £84,000 tax bill. By the way, if you're a 20% taxpayer, which you won't be by then, but it's still £54,000 tax bill. So he sells the 400,000, he pays a tax bill, he pays the estate agents, and he's left with about £300,000. Colin says, hang on a minute, you told me never to sell, principle number 1. So what do? So Colin refinances it. He borrows 75% of what it's worth. So if I borrow 75% of 400,000, that's 300,000. So Colin ends up borrowing 300,000. He has £300,000 in his bank, same as John. What's the difference? The difference is Colin still owns the house. John's lost it. So we both got £300,000, but Colin still owns his. Does that make sense? It's not a trick question. Colin still owns it. He owns it for another 15 years. And guess what? They double every 15 years. So his £400,000 house, now, what do you think it'll be worth when they double again? 800,000. And whether Colin is in it or not, I hope he is, but another 15 years after that, the £800,000 house, him or his family will own it. What will that be worth? 1.6 million. So because John sold the house, he and his family have just missed out on £1.2 million worth of growth. Never ever sell your investment property. Never sell your investment property. I'm literally telling you to take these properties to the grave. Die owning them. I mean, all these people in the 60s and 70s, and they're busy selling off all their investment properties to sort things out and paying massive capital gains bills. It just drives me crazy. I'm like, you need to die first. Die first. Now, I don't mean die early, just die when you're planning to die and let the properties be sold later. There's something called, and you can Google this later, capital gains tax washout. Capital gains tax washout. What is this? If the property, say I pass away and I've got a house that's worth 800,000 and I bought it for 100, so me and my family have made a 700,000 pound gain by this time, and I pass away, on my death the capital gains tax gets written off. Written off. No one has to pay it. I'm not going to I'm not going to come to inheritance tax in a minute, but it's just written off. If I sold it the day before, I'll just pay 28% tax on 700,000, a couple of £100,000 in tax. If I die first, then no capital gains tax to pay. So why would you ever pay capital gains tax? It's crazy. Okay, inheritance tax. Now when you pass away, the first 325,000 you pass on goes tax free. If you're in a couple, the second person dying, 650,000 can go tax free or as a tax break. Okay, right, I'm going to assume for simplicity that your own residential house and its equity and cars and your stocks and other stuff all got used up in the allowance, just to make it simple. So we can compare apples with apples, so let's assume that happens, and let's go back to the earlier scenario where John paid off his mortgage, and so he spent the last 20-30 years being taxed a lot extra income tax. But what else happens to him? Now here's what happens. He's got a £1 million portfolio. When he passes away, no debt on it. So the government come along and they say, John, or John's kids, whoever inherits it, you've got 40% tax bill on this, and you need to pay that £400,000 in the next 12 months roughly. Now, unless his kids are genius, he didn't predict when he was going to die. So let's say he dies in a flat market or a falling market. So now the kids have got a year to sell some of the stuff off and pay the tax bill. They end up selling to someone like me that offers them 15 to 20% less than it's worth. He's worked his whole life to build this pot up further. You give this to his kids, they sell it for 100,000, pay the bill, and end up with about less than half of 500,000. Less than half of 500,000 pounds. If we go back to Colin in his example, because he didn't pay the mortgage down, so his income tax efficient, and he's got £1 million pot. So they've got £750,000 of debt on it. Remember, this isn't a problem for him because it's a good debt. Somebody else is paying for it and it's making him money on top. We're making him £200 a month each. And if he's got 9 of them, that's £1,800 a month. 25 grand a year, he's happy as roses. When he passes away, the 40% tax is charged only on the equity. So 40% of £250,000, their bill is only 100,000, not 400,000. I know which bill I would rather have for my kids. This stuff is amazing. By the way, I'll show you how to make that about £10,000, but I can't do that now. It'll take longer, and you don't even want to be paying that either. Okay, does this make sense so far? So from the two principles, we're income tax efficient, capital gains tax efficient, and inheritance tax efficient. However, we're now really tax efficient, but where's the profit? Right, some of you will be thinking you're going to need a lot of houses at £219 a month to be able to retire comfortably. So let me show you where the profit is and how the professionals take the profit from property. And you could do the same with just one or two of these properties. So let's imagine you've got £100,000 property, 75,000 mortgage, and 25,000 equity in the house. Okay, so the market goes up 20%. So your £100,000 property now becomes worth £120,000. Okay, and let's assume you go back to the bank. You go like Colin did, say, hey, the house has gone up in value. Can I please borrow 75% of the new value? I've increased my rents to pay for the cost. The bank says, of course you can. He has to pay the old mortgage off, 75,000, and he gets left with £15,000 that the bank puts in his current account. Okay. Now there's three things I want you to notice on this page. The first is, even though you borrowed more money, the equity is still higher than it was to start with, and it continues to do this throughout the years. The second thing that really excites me, it's something called the compound effect. So next time when you go, next time it goes up 20%, it's not 20% of 100, it's 20% of 120. So it goes up to 24,000. Next time it can release 18,000. The time after that it can release 21,600. This release is inflation proofed, but more on that in a minute. Final piece, what's really beautiful about this is that the money that gets released, because it's money that you borrowed, it has no tax to pay. It's not income, it's money you borrowed, it's tax free. I can't see you smiling, this is amazing. Imagine you set off and you buy this house and then you buy a second. So it starts with 2, they go up 20%. He can release 15 grand from this one and 15 grand from this one, and he's got 30 grand. Guess what he does with the 30 grand tax free? He buys a third, another house. Now he's got 3 going up. We need to go up 13%. He can release money and buy a fourth. 4 going up about 10%. He releases and buys a fifth. 5 going up 8%. He can buy a 6. 6 going up 7. And he can buy a 7th. 7 going up 6% and buys an 8th. It gets faster and faster and faster. Start now. Not later. The sooner you start, the sooner you get here. That's just crazy. It's going really, really fast. You just want to get started with this, whether you do it with me or do it yourself. Just get going. Okay. Final piece. You'll get this even more in a while. You can see I'm passionate about this. So let's imagine Colin does this and he builds his portfolio. And you remember earlier I said, let's be cautious. Let's just assume 5% per annum growth, not 7.9. So 10 years from now, we meet Colin. And Colin's properties have gone up 5% a year, even without compounding. They're worth about 150 each. By the way, just starting out with 2, he would have 9 by then. 9. So we meet Colin 10 years from now. He started off with 2, but he's got 9. Okay. And he's got £1.4 million. 9 properties worth 150 each. 1.4 million. He's got 1 million of mortgages, but this is good debt. Some of the tenants are paying for it, and these properties are making him £200 a month. Each £25,000 a year, and he's got 350,000 in equity. Now we meet Colin again. How's it going? He says, I'm delighted with where it is, but I've got to tell you, 9's enough for me. You know, I want to get some great properties, but 9 is definitely enough. I go, that's cool. So a year later, the property market has gone up, and it goes up another 5%, to be cautious. So the property market's gone up 5%, and I meet Colin again. I say to Colin, great news, your property is worth 1.4 million. It's gone up, and it's now worth 1.47. It's gone up 70,000 in value. you could release the money and buy some more properties. Now Colin says, that's great, Wayne, but you've forgotten. I told you 9's enough. I don't want any more than 9. That's enough. So my response, that's great, no problem. Still release the money like you have done for the last 10 years and grow your portfolio. But instead now, release the money and spend it on holidays, spend it on a car, quit your job, live off it. 50,000 tax-free is like 70,000 today before tax. Now the beauty is in inflation, because it's a compound effect. Next year, you can release 55,000, and the year after 58. He's on 52,000 a year for the rest of his life, inflation proofed. Who'd like that? And he's paying no tax, not a penny. It's crazy. Now, a couple of things. The property market doesn't go up 5% a year steady like that. We get peaks and troughs, like we talked about earlier. So when it goes up 10%, Colin has to be clever. As I said, you know what? I've been able to release 105,000 all in 1 year, but I've budgeted on 52. So I'll spend 52, and the other 52 I'll put in a contingency pot. And he has 4 or 5 years of double-digit growth, like London's just had, and he should be building a contingency pot. Then the market might go flat for 5 years, 0% growth, or a bit of a drop. He can't release anything, but he lives off the extra money in the bank, as he banked before. So this is an averaging process. If on average it goes up 5% per year, that is on average what Colin will what Colin will be able to release. Does that make sense? Now you might say, but I only need 30,000 tax free. But I've got to say I'm more cautious than that, like 5%. I only believe 4%, so I'd rather model at 4, and I'll say that's fine. So 30,000 tax free at 4%. You needed 40,000 of growth at 4%. That means you'll need £1 million portfolio to retire. You know exactly what size you need. Someone else says, you know what? 30,000, you're kidding me. I need 60,000 a year. I fly all over the world. I need my money. So you want 60,000 a year, and also agrees, I want to be cautious at 4%. So now we know 60,000 tax-free means 80,000 a year at 4%. So we'll need at least a £2 million pot. He knows exactly what he needs. Once you get this, you can plug in your own numbers, and hey presto, you've got your vision and you're tax efficient. You know where you need to get to in terms of portfolio size and when you're finished. So we're being tax efficient right across the piece by never ever selling our investment properties. As it goes up in value, we increase the debt against it, and you can use this strategy with 1 to multiple properties. Okay. If you find this useful, then hit the like button, share and subscribe. Thanks for watching.